Welcome to The Explainer. Today, we're going to break down how Canadian income tax is actually calculated. We're going to turn what can feel like a really confusing process into a clear, manageable journey. It's a fantastic question, right? Because it's not just a simple percentage of what you earn. No, it's a multi-step process, a journey from a really big number down to a much smaller one. And we're going to walk through it together. I like to think of it like sculpting. Seriously. You start with this big, rough block of stone. That's your initial tax calculation. Then you get a set of special tools. We call them tax credits to carefully chip away at it until you reveal your final, much more refined tax bill. Okay, let's dive right in. The very first step on our journey, the starting point for our sculpture, is figuring out what's called your base text. Now, this isn't the amount you'll actually have to pay, but it is the crucial core number we need to start with. It's our uncarved block of stone. So how is that base tax even figured out? Well, Canada uses what's called a progressive or marginal tax system. Now that sounds complicated, but it just means your entire income isn't taxed at one high rate. Instead, think of your income in different buckets. As you can see right here, the first bucket, up to about 57 grand, is taxed at 15%. If you earn more than that, only the money in the next bucket gets taxed at the higher 20.5% rate, and so on. All those little pieces get added together, and that creates our initial big block of stone that we need to start sculpting. So we've got our big, uncarved block of stone, the base tax. Now for the fun part, actually chipping away at it. And our primary sculpting tools for this, they're called tax credits. Now these tools, these credits, they come in two main flavors. You've got refundable credits, which are amazing. They can actually give you money back even if you owe zero tax. But the most common tools, the ones we're going to focus on today, are non-refundable credits. Just think of these as a really powerful discount coupon that can reduce the tax you owe, but only down to zero. Okay, and this is the crucial point. It's a really good one. When you hear about a tax credit amount, like a $10,000 credit, that big number is not what you actually save on your tax bill. Instead, for most federal credits, you take that big number and you multiply it by the lowest tax rate, which is 15%, to find your actual dollar savings. This is the difference between the size of your chisel and how much stone it actually chips away. Let me show you how it works. Okay, so let's look at the credits that pretty much every single taxpayer in Canada can use. These are the foundational tools in every sculptor's kit, starting with the most fundamental one of all. Every Canadian resident gets something called the basic personal amount. This just recognizes that a chunk of your income is needed for basic living. For 2025, that's a credit of up to $16,129. So what does that actually save you? Well, remember our rule. We apply that 15% conversion rate. And just like that large credit amount translates to a direct reduction of your tax bill by about $2,419. That is the real magic. That's the first huge chunk you get to chip right off your tax stone. Now, if you earn employment income, so basically if you get a T4 slip from an employer, you also get the Canada Employment Amount. This is to acknowledge all those little work-related expenses like uniforms or supplies. And yep, you guessed it, we apply our 15% rule. This credit saves you about $220 in federal tax. Now, it might seem small, but these savings really do add up, chipping away piece by piece. So beyond those basics, the tax system has a whole bunch of more specialized tools, credits that adapt to your personal circumstances and your life events. Let's see how this builds and customizes your own tax sculpture. Life events like going to college or university come with their own specialized tools. As a student, you can claim a credit for your tuition fees, which can be thousands of dollars. On top of that, the interest you pay on government student loans is also eligible for a credit. And what's really cool is that these tools are flexible. If you don't have enough income to use the credits right now, you can carry them forward to use in future years, or even transfer a chunk to a supporting parent or spouse. Huge milestones like buying a home have their own tax tools. If you're buying your first home, the government provides a home buyer's amount. It's a $10,000 credit, which, using our 15% rule, carves about $1,500 right off your final tax bill. And similarly, there are some really powerful credits available if you're doing renovations to make a home more accessible for a senior or a person with a disability, which recognizes those significant and really important costs. The system also provides tools for those of you supporting family members. For instance, if you're supporting a low-income spouse or partner, you can claim a pretty significant credit. There are also specific caregiver credits if you're caring for an infirm relative. These tools recognize your financial contribution, and they can reduce your tax bill by thousands of dollars. Look, the goal here isn't just to list a bunch of credits for you to memorize. It's about giving you a framework, a new way to think about them. Understanding how these tools work, that's what empowers you to manage your own financial picture way more effectively. So, by understanding this whole journey from that big base tax number down to your final bill, and by knowing the difference between a credit amount and your actual savings, you're no longer just a passive participant. You become the sculptor of your own tax outcome, and you're fully equipped with the tools to shape it.